While the waning dominance of the Magnificent Seven tech stocks has caught many investors' attention, the real surprise story perhaps of 2025 has been the resurgence of European equities. Senior product and investment strategist Mark Jokum from Global X ETF joining me now to discuss. Good to see you, Mark.
Good to see you as well.
What are we seeing here in terms of, Europe isn't back?
Yeah, it really has been the silent outperformer in 2025, which comes to many surprises. A lot of people were thinking with Trump coming in about MAGA, make America great again, but it could be about MEGA, make Europe great again.
I like it.
Yeah, and what we've seen over the last, so far to start this year, is European shares have actually been the star performer. They're up about 12% year to date versus the broader market, which is only up around 3%, and the Australia and US market is only up 2%. And that difference between the European market and the US market is the biggest differential and the biggest start to the year that we've seen since 2000. So a lot of people are starting to think, well, hang on, is this going to be the start of a new secular bull market in Europe? Is this going to be the resurgence? And there's plenty of tailwinds that are driving the European equity market a little bit higher.
And what are some of those tailwinds? Because I guess we've also got this concern about, is there going to be a huge trade or tariff war between Europe and the US?
Yeah, I think we're seeing 4 or 5 key drivers. The first is around on both the economic and corporate earnings surprises. So if you look at the data, there's actually been quite a surprising upbeat to both the economic surprise and also corporate earnings revision as well. So that's been a really good start because Europe historically was kind of one step forward, one step back. So now the growth outlook looks a little bit more promising in Europe. The second is around the some of the fiscal reforms. So, there's an election going on in Germany at the moment, moving a bit from the left wing to right wing. That's going to be pro-growth, pro-business. You saw the Draghi report come out from a former ECB chair asking for more competitiveness and more innovation. Not just that, when you look at the government debt to GDP, Europe's at about 90% versus the US at about 120%. So very different there. And then you've also got macro tailwinds as well. So the ECB started cutting interest rates long before many other central banks. They cut in mid-2024. They're now down to around about 2.75%. And there's probably going to be another 3 cuts priced in for the European Central Bank. And then the last 2, I would say, is one is around the potential ceasefire with the Russia-Ukraine war. Now, markets are pricing in about a 73% chance of that actually happening. And that could be good in terms of creating a bit more stability, but also the reconstruction process within Ukraine. I've seen reports show that there could be hundreds of billions of dollars, which could definitely benefit the domestic sector. And then finally, the other thing is just around valuations. The European market's trading at a forward multiple of around about 14 to 15 times earnings, which is very different to the US, which is at about 23 times. And you're just starting to see a few more investors positioning within European equities, even though there is some caution still to be remembered.
So what are some of the cautionary points that we should focus on? And I guess as well, how much does a potential ceasefire in Ukraine change the dial?
Yeah, so I think markets are really pricing that in already.
Yeah.
So hence the upside to Europe could be capped. If we don't see a potential ceasefire, that's where there could be a little bit of left tail risk and a bit of downside. And I think in terms of some of the challenges, I mean, there's still structural factors that Europe need to get over. There's still some fiscal challenges ahead, particularly with the US. I know they have inflicted a bit of a trade war, and we're going to see how this materializes. But if they start diverting their attention away from Mexico, NATO towards Europe, well, that could be a little bit of a structural headwind as well. But overall, we are seeing a lot more investors positioning within Europe, albeit it is coming from a lower base. So while the risks are still there for Europe, it is looking like an interesting pocket.
How much Australian investor interest is there in Europe?
Not a lot,
Yeah.
to answer your question very bluntly. So far, we've seen around about 10 to 15 million dollars go into Australian equity, go into Australian listed ETFs that are tracking European shares. And that is about half of what we saw in the previous year. But remember, in 2023, we saw just over $400 million in outflows from those European equity ETFs. When you look at a bit more of a domestic focus, January was the best 1 month surprise in terms of the amount of money getting allocated to European equities. So globally, we're seeing a few more investors going into Europe. And not just that, but also from an institutional positioning, we're seeing institutions slowly go a little bit more, not necessarily overweight, but increasing their underweight position from Europe. And although it's below their 20-year historical average, you're seeing just a little bit more bullishness. So it could be the start of something, but like I said, there still are risks to consider.
And so then, I know we always talk about there's a way to get in through ETFs. What are sort of the ones you're looking at in terms of Australian investors gaining exposure to Europe?
So I think Australian investors wanting to get exposure to Europe can go for a pure regional focus ETF, and that's where you can track a portfolio of the 50 leading blue chip companies in Europe that are on the Euro Stoxx 50 index, which is one of the most widely recognized exchanges. And we've got an ETF for that, ESTX, so it's a Global X Euro Stoxx 50 ETF. Tracks, like I said, 50 leading companies. So you've got ASML, LVMH, L'Oreal, BBVA, SAP, some really good blue chip quality names. But for those investors who still want a bit more of a global focus, but want a bit more of a regional tilt towards Europe, you can actually look at some ETF strategies such as our Global X, World X Australia GARP ETF, Growth at a Reasonable Price, GARP. And that's got about a 20% allocation to European equities versus the broader market, which is at about 12%. And that's because not only are they trying to find companies that are growing their earnings, and we talked about those corporate earnings revisions, but also trading at reasonable prices. And we talked about that big valuation discount that Europe now has. So between ESTX and GARP, those are two ways that investors can position themselves for a potential European rally.